$897 billion in just 12 months, vanished from the mainland, reappeared in Hong Kong. And while you're reading headlines about a $2.8 trillion bet into China, the smart money is doing the exact opposite. It's leaving, not slowly, not quietly, but in a torrent that history tells us only happens right before the gates slam shut. Right now, you are being fed a lie, a comfortable, convenient lie. You were being told that the world's largest asset manager is doubling down on the Chinese economy. You're being told that a $500 billion opportunity is opening up. The headlines are designed to make you feel like you're missing out, like the smart money knows something you don't. And you know what? They do know something you don't. But it's not what you think. They aren't buying the dip. They are orchestrating the exit. What you are witnessing isn't an investment. It's a liquidation. And if you don't understand the difference between capital injection and capital flight, you are going to be the liquidity that allows them to escape. This changes everything. It changes your portfolio. It changes the global balance of power. And most importantly, it changes the immediate future of your own financial security. Because when nearly $1 trillion moves across a border in a single year, it doesn't just mean someone is moving house. It means someone knows the house is about to burn down. The next 20 minutes matter more than most headlines you have read this entire decade. As we move through 2025, the conversation around China and global capital flows is likely to shift from is it investable to how did so much money get out so fast? If you own any international equities, if you have a retirement account exposed to emerging markets, or if you simply hold dollars and think you're safe from a sovereign debt crisis on the other side of the world, you need to listen. This is stage 3 of a 4-stage pattern that has destroyed the wealth of every major civilization that has ever tried to control the uncontainable. It happened in Weimar Germany. It happened in 1997, Asia. It happened in Lebanon. And it is happening right now in the second largest economy on Earth. I can prove it to you. I can show you the math. And I can show you exactly why the BlackRock bet is actually the BlackRock lifeboat. Here is the pattern. It is simple. It is brutal. And it is undefeated. Stage 1 is the foundation. The system works. Trust is high. The currency is backed by growth or hard assets. The rules are clear. In China's case, this was the post-2001 WTO entry era. Hard work, real manufacturing, massive growth. Money flowed in because the return on investment was real. You built a factory, you made a profit, you kept the profit. Simple. The mechanism of control, the closed capital account, worked because nobody wanted to leave. Why leave the party when the champagne is still flowing? Stage 2 is the expansion and manipulation. The growth slows, but the expectations don't. So the system compensates. It prints. It builds ghost cities. It creates debt to fund the illusion of continued expansion. This is where the cracks start. The elites see it first. They start moving small amounts of money out. Not enough to trigger alarms, just enough to diversify. They buy a condo in Vancouver, a winery in France. The government notices but tolerates it. It's manageable. This phase can last for decades. It feels like stability. But underneath, the foundation is rotting. The currency is no longer a store of value. It's a claim on future debt that can never be repaid. Stage 3 is the loss of control. We are here now. This is the squeeze. The smart money realizes the math no longer works. The debt is too high. The demographics are terminal. The return on investment has turned negative. And suddenly, the trickle of capital flight becomes a flood. The government panics. They clamp down on the little guy. They ban crypto. They stop citizens from buying gold. They limit ATM withdrawals. But, and this is the critical part, they leave a back door open for the institutions, for the connected, for the systemically important. Why? Because the system needs them to survive a little longer. This is the stage where you see massive, inexplicable flows of money to safe havens like Hong Kong. It's not investment, it's flight. Stage 4 is the break, the reset, the collapse. The gates close completely. The currency is devalued overnight to wipe out the debt. The people who got their money out in stage 3 are the winners. They own hard assets and safe jurisdictions. The people who believed the narrative, who kept their capital inside the system, are the losers. Their purchasing power is vaporized. They are left holding the bag. This pattern is not a theory. It is a historical constant. Let me take you back to 1997, South Korea. The narrative was the Asian miracle. Everyone believed it. The debt to GDP ratios were climbing, but nobody cared because the growth looked exponential. The foundation, stage 1, was solid manufacturing prowess. Stage 2 was the reckless borrowing in foreign currencies to fund massive conglomerate expansion. But then came stage 3. The insiders saw the short-term debt coming due. They saw the reserves dwindling. By December 1997, Korea's foreign reserves didn't just dip, they collapsed. From $30 billion to $4 billion in weeks. That is a stage 3 squeeze. The money didn't just evaporate, it fled. Foreign investors and local elites who understood the balance sheet aggressively moved capital out of the yuan and into the dollar. The government tried to defend the peg. They raised interest rates. They begged citizens to donate gold rings to save the country. It was patriotic. It was emotional. And it was futile against the math. Stage 4 arrived with brutal speed. The yuan collapsed. The IMF stepped in. Corporate giants fell. The standard of living for the average Korean family was set back a decade. Those who moved money out in stage 3 bought back in later at pennies on the dollar. They became the new aristocracy. Those who listened to the government and kept their savings in yuan saw their life's work cut in half. Verify the stages. Stage 1, growth. Stage 2, debt expansion. Stage 3, capital flight and reserve depletion. Stage 4, currency collapse. It played out exactly as the pattern dictates. Look at Lebanon, 2019, a more recent, more painful example. Stage 1, the Paris of the Middle East. High interest rates on deposits attracted billions from the diaspora. The peg to the dollar was sacred. It worked. Stage 2, the government used new deposits to pay interest on old deposits. A classic Ponzi scheme masked as banking. The debt swelled. The productivity stalled. Stage 3 began in late 2019. This is the part that mirrors today perfectly. And while the banks were telling average citizens that everything was fine, while ATM limits were being quietly imposed on the working class, nearly $3.5 billion was transferred abroad. Who transferred it? The bank owners? The politicians? The connected elites? They used their influence to bypass the controls that were trapping everyone else. This is the elite exit. They knew the system was insolvent. They didn't try to fix it. They simply got their money out. Then came stage 4. The banks shut their doors. The Lebanese pound lost 90% of its value. People's life savings were locked in accounts they couldn't access, converted to a worthless currency. The lollar, a fake dollar trapped in the system, became a cruel joke. The $3.5 billion that left? That money is safe. It is in Switzerland, in London, in real estate. The people who moved it are fine. The people who trusted the system are destitute. The pattern does not care about fairness. It cares about positioning. Now, let's look at the grandfather of all monetary collapses, Weimar Germany, 1922. We think of wheelbarrows of cash, but that was stage 4. Stage 3 happened before the hyperinflation. In 1922, the German mark was already weak, falling from 320 to 7,400 per dollar. But the industrial tycoons, the Stinnes and the Thysens, they didn't hold marks. They borrowed marks to buy hard assets, coal mines, factories, foreign currency. They used the flight capital mechanism. They moved wealth into foreign exchange while the window was open. The government kept printing to pay striking workers in reparations. That was the stage 2 debasement. The stage 3 squeeze was the realization by the international community and the domestic elite that the debt could never be paid. Capital flight became unrestricted for those with the means, while the average German watched the price of bread tick up. Then came stage 4. 1923, the currency went to zero. The middle class was wiped out. But the industrialists who had effectively shorted their own country, they ended up owning everything. They paid off their debts with worthless paper and kept the hard assets. Verify the stages. It is always the same. Foundation, expansion, the squeeze, the collapse. And in every single case, the squeeze is marked by one undeniable signal. The elite move their capital to a safe haven while telling the public to stay put. Which brings us to today. December 22nd, 2025. We are watching stage 3 play out in real time. You are seeing headlines about BlackRock betting on China. Let's look at the data. Let's look at what is actually happening. Because the numbers do not lie, but the headlines do. The headline says, BlackRock moves $2.8 trillion into China. That is false. It is a manipulation of data so gross it borders on malpractice. Here is the reality. BlackRock has $13.4 trillion in assets under management globally. They are not moving 20% of their entire global book into a single struggling economy. That is a mathematical impossibility. Here is what the data actually shows. BlackRock is selling. In July 2025, they reduced their stake in Sinopec, the Chinese energy giant. In October 2025, they began offloading commercial properties in Chinese cities at steep losses. Why would a company betting the farms on a country be selling its prime energy and real estate assets? They wouldn't. So where is the $2.8 trillion figure coming from? It's a distortion of the outflow. Look at Hong Kong. This is the smoking gun. In 2024 alone, Hong Kong saw net fund inflows of 7 trillion Hong Kong dollars. That is 897 billion US dollars. Nearly $1 trillion. Where did that money come from? It didn't come from Kansas. It came from the mainland. This is the greatest capital flight in history. Chinese investors, realizing their domestic real estate market is dead, realizing their local debt is toxic, are desperate to get money out. But they can't just wire it to New York. The capital controls block them. So they use the Mutual Recognition of Funds scheme. They use the Southbound Connect. They move money into Hong Kong investment products. And who is waiting in Hong Kong to manage that money? BlackRock. BlackRock isn't bringing American money into China. They are positioning themselves in Hong Kong to catch the Chinese money running out of China. They expanded their Hong Kong hub significantly in 2025. They acquired $80 billion in assets from Citigroup or S private banking arm. They are building the infrastructure to be the bank account for the escaping elite. This is stage 3. The we are here moment is undeniable. January 1st, 2025. The mutual recognition of funds cap was raised from 50% to 80%. This is a regulatory change that allows more money to flow across the border. Why would a government obsessed with control loosen the rules? Because the pressure is too high. If they don't open the valve a little, the pipe will burst. They are allowing a controlled release of pressure. The elites are being allowed to exit. October 2025, BlackRock sells commercial real estate. They are dumping illiquid assets inside the wall. December 2025, BlackRock expands wealth management in Hong Kong. They are collecting liquid assets outside the wall. Do you see the pattern? Sell the trapped asset. Buy the escape vehicle. This is not a bullish bet on China. This is a bearish bet on the renminbi. This is a bet that the capital wants to leave. Why is this happening? What is the mechanism? It comes down to the impossible trinity. In economics, you cannot have a fixed exchange rate, an open capital account, an independent monetary policy all at the same time. China has tried to defy this law of physics for 20 years. They wanted a stable currency to trade, they wanted to print money to stimulate growth, and they wanted to control the flow of capital. But the debt has become unmanageable. The local government debt crisis is a black hole. To fix it, they need to print trillions of yuan. If they print that much, the currency must devalue. If the currency devalues, everyone with wealth wants to sell their yuan and buy dollars or gold. If everyone sells yuan, the currency collapses. So the government is trapped. They are tightening the screws on the average citizen. Risk classifications on gold and silver have been raised, making it harder for normal people to buy precious metals. The back door is only for the institutions. The mechanism is a controlled default. They will let the currency slide, but they need to get the important money out first. We are deep in stage 3. The flight is happening. The stress tests are failing. The smart money is not investing in the growth of the Chinese economy. They are investing in the infrastructure of exit. Who wins and who loses? This is the most important part for you. The losers are the holders of domestic Chinese assets. Real estate in Tier 2 and Tier 3 cities. Yuan-denominated bonds. Wealth management products sold by local banks. These assets are the bag. They are being sold to the public while the institutions rotate out. When the stage 4 break comes, when the yuan is eventually revalued lower to clear the debt, these assets will be worth significantly less in real terms. The winners are the holders of hard assets outside the jurisdiction. The Chinese billionaire buying a penthouse in Manhattan, winner. The BlackRock client holding a global infrastructure fund that owns ports and data centers in Southeast Asia, winner. They have swapped a paper claim on a failing system for a physical claim on the global economy. The mechanism of gain is the preservation of purchasing power. If the yuan devalues by 30% against the dollar, which is a conservative estimate given the debt load, simply having your money in dollars is a 30% gain in purchasing power relative to the victim of the crash. So, what do? The window is still open, but it is closing. The fact that nearly $1 trillion rushed into Hong Kong in 1 year tells you that the rush is accelerating. You do not want to be the last one trying to fit through the door. Action item number 1, audit your exposure. Do not trust the name of the fund. Look at the holdings. If you own an emerging markets ETF, you likely own a significant chunk of Chinese banks and real estate developers. You are providing the exit liquidity for the institutional sellers. Reallocate, move away from broad, passive exposure to opaque regimes and into specific, transparent jurisdictions. You want rule of law. You want property rights that cannot be revoked by a midnight policy change. Action item number 2, understand the difference between exposure to China and exposure to the Chinese exit. Investing in a company that sells luxury goods to Chinese consumers is different from investing in a Chinese bank. One benefits from the spending of the escaping wealth, the other dies with the domestic debt. Look for companies that service the flow of capital and goods, not the storage of debt. Shipping, logistics, global energy. The Panama Canal port deal BlackRock made, that is a strategic hard asset. That is the kind of thing you want to own. real things, essential things. Action item number 3, get your own capital out of the paper system where possible. This applies domestically too. The same forces of debt and devaluation are at work in the West, just on a different timeline. If you have all your wealth in paper promises, stocks, bonds, currency, you are vulnerable to the stage 4 reset. Own physical gold, own silver, own land, own things that do not have counterparty risk. The Chinese elites are buying gold. Central banks are buying gold. Why are you holding paper? Action item number 4, ignore the headlines. Read the flows. When the news says BlackRock bets on China, look at the flow data. The flow says outflow from mainland, inflow to Hong Kong. Trust the flow. The flow is the truth. The headline is the marketing. Action item number 5, position for volatility. When a system as large as China's undergoes a stage 4 correction, it sends a tsunami through the global economy. Commodities will be volatile. Currencies will swing. Do not use leverage. Leverage kills you in the chop before the move happens. Stay liquid in hard assets. Stay unleveraged. Stay patient. You cannot print your way out of a solvency crisis. You cannot hide a debt problem this large forever. The laws of mathematics are patient, but they are unforgiving. The system in China cannot avoid a correction because the debt must be cleared. It can be cleared by default, deflation, or by printing, inflation, devaluation. History shows governments always choose the latter. Always. This is a mathematical certainty. The only variable is time. So, are you going to listen to the headline that tells you to buy the bag? Or are you going to look at the $1 trillion fleeing the scene and realize that the smart money is already halfway out the door? The choice is yours. But the window won't stay open forever. The gatekeepers in Beijing are watching the same flows we are. Eventually, they will decide that enough is enough. And when they lock the door, they won't announce it in advance. Subscribe now. Because what I have shown you is just one piece of the global puzzle. The capital flight from China is triggering reactions in Europe, in the US bond market, and in the price of gold. The next video will connect these dots and show you how this silent exit is actually funding the next leg of the inflation crisis here at home. You need to see the full map. The vault doors are closing. The biggest players are moving their chips off the table. The only question is, will you be standing there holding the empty bag when the music stops? Verify the data. Trust the pattern. Make your move.